Yes, that share screen. Where's my share screen? I don't think I did it right. Share. Okay. Okay. Sorry for the video. I forgot to hit record. But anyway, we're just talking about financial analysis and how
you did share, but did you actually record?
I should have. Yeah, it's recording. Yeah, thank you. Okay, so we're talking about financial analysis. So there's three, they call it dimensions. That's kind of, I mean, every time I see the word dimension, I'm thinking that throws me off. So there's three different facets, I guess, of analysis. You've got liquidity. How able is the company to convert assets to cash? Solvency. How able is the company to make interest payments? And then profitability. Do they make a profit? Are they doing well? So stock prices and their changes. We learned in chapter 14 that stock prices are going to go up and down based on investors' expectations, economic performance, things like that. So that all goes into play here. And if you're looking at buying some stock, if you go out and you want to do some research first, you can find a lot of these ratios. You can calculate them yourself, kind of get an idea of how the company's doing. Do you want to invest in them? Once you learn about what they are. All right, so techniques for analyzing financials: analyze and interpret a company's financial performance and condition. All right, so analytical methods, those are going to be methods that we use to just look at the changes in the various amounts in the financial statements. We'll do horizontal, which goes across, so you would compare year to year, or there's vertical, where you use one of the total numbers as a base number and you calculate what percentage the items in that group are in relation. And we'll show you. It's easier to see it done. So ratios express a financial statement item or set of items as a percentage of another financial statement item and the relationships between the two. This is going to make a lot more sense when you see it done. Horizontal analysis, like I said, is looking at the increases and decreases in the amount and the percentage of comparative financial statement items. Example, you compare sales from 2020 to sales in 2019. So if they increased or decreased, you're going to figure that number out and then determine what percentage the increase or decrease was. So we'll look at that shortly. So important here. When comparing statements, doing horizontal analysis, the earlier, the older year is the one that you're going to use as your denominator. They call it a base year. That's going to be the one you use as your denominator. And I'll show you. All right, so this first one, we've got horizontal analysis comparing cash and accounts receivable. All right, so what you're going to do is you're going to look at the previous year. You're going to look at the current year. So obviously this is the older year. Do we have an increase in cash or a decrease in cash?
Increase.
We have an increase of cash of $32,250. Well, we want to know, okay, well, my cash increased $32,250. How do we calculate that as a percent? So you would take your $32,250 increase, divide it by the oldest year, which is going to be your base year, and that's going to give you a decimal. You're going to get an answer like 0.5098. When you get answers like that and you know it's supposed to be a percentage, multiply it by 100, that's going to give you your percentage. So that cash increased 50.98%. That make sense? Don't you see it done? Okay. Accounts receivable, did it increase or did it decrease?
Decrease.
It decreased. It went down 12,000. So you'll take that 12,000 and you'll divide it by 122,000. And you'll get,
9.84%.
I got 0.0983. Now that may, you may get more decimals than that. I gotta reset my,
Let's say 9. I just rounded 9.84.
okay. And yeah, you're gonna have a big problem to do. Be sure you're watching the instructions real close as to like how many decimal places to go and that sort of thing, because it will really mess you up if you're using 2 and it's supposed to be 1, or you're putting 1 is supposed to be 2, you know, Cengage is sensitive. So I got 9.83%. If you got 9.84, it could be because of my decimal places. And honestly, I cannot remember how to decrease those. I used to have it up to 4 and it started getting on my nerves, so I moved it back down to 3. So just as you're doing these calculations, just make sure, and these you're just doing one thing, but make sure you're paying attention to what number of decimal places they want. All right, on example 2, the wording is messed up because I was copying and pasting. This should say the comparative inventory and prepaid expenses balances, and it's not supposed to be on 2 pages, but thanks to Office Online version, it cut my pages off in the wrong spots. So you've got 1 down here and 1 up here. So we're doing the same thing, except this time we're comparing inventory and prepaid expenses. So your inventory, did it go up or down?
Down
It went down by how much?
8,000.
So this is a decrease of 8,000. So you'll divide that 8,000 by the oldest year, and you get, I got 2.14%. So if you get a number like this, be sure you multiply it by 100 to get the percentage. Y'all get something close to that? Yes, no, maybe.
Yes.
Oh, I fixed it. Surely it's not that easy. Okay, I did. All right, what was that one we were looking at? Let's see, 12,000 divided by 122. Yeah, I got 0.09836, so it would be 9.84.
So if we have a decrease, the percent has to be like this much.
Yes, because it's showing it decreased 2.14%.
Oh, okay.
Okay, y'all good? All right. The next page, we have our prepaid expenses. So what happens when you get in a hurry? The formatting got all screwed up and I didn't realize it. All right, so our prepaid expenses, did they go up or down?
Increase.
They increased $600. So we would divide that 600 by 6,900, and we get
8.7%.
8.7.
Round up.
Yeah, rounding up.
I must have used the wrong number. Okay, so I get 0.08696. So multiply by 100, get your percentage, and it's 8.70. Yeah, I'm trying to put a dollar sign there. All right, so we have an 8.70 increase. It may say 1 decimal place, it may say 2. I don't know. I think that's a 6. No wonder I couldn't read it. Made it look like a 0. All right, y'all good so far? Okay, because we're gonna kind of go through this quick, but it's not hard. You're just plugging numbers in. All right, so vertical analysis, we're gonna kind of do the same thing, except we're going up and down. So it's a percentage analysis of the relationship of each component in a financial statement to a total in the statement. So, in other words, each asset on the balance sheet would be stated as a percentage of total assets. So you would use total assets as your base or your denominator when you're dividing out. All right, and then liabilities and stockholders' equity would be stated as a percent of total liabilities and stockholders' equity. So that's the base you would use for a liability or an equity item. And then for the income statement, each item on the income statement is stated as a percentage of sales. So when you're doing these, for instance, we've got an example here. Whatever your base number is in a problem like this, it's going to be 100%. Your base number is, it's on the bottom, it's 100%. So what you're trying to determine is, for these other numbers, what percent are they of sales? So how much is this cost of goods sales number percentage-wise of sales? So you're going to take 441,000. You're going to divide it by 910,000. So what is my, I've got 48.46. So what y'all get?
Yeah.
I'm not trying to insult your intelligence with the percentage thing by multiplying by 100, but it seems like some people forget. Some people may not have ever learned in high school. I mean, I don't know. So I don't want you to be floundering trying to figure that out, because I've noticed that's been a hang up for my online people, is converting these things to percentages. I mean, it's relatively simple, but I forget people's names all the time. So that shouldn't be complicated either. So it is what it is. All right, for gross profit, divide 469,000 by 910,000. And that's going to give us 0.5154. Messy. Or 51.54%. I think that's merchandising. That's accounting one, never mind. This number, this gross profit percentage number, that's going to be a big deal for a merchandising company, because it relates to markup. How much are you marking up your product cost for your sales? Like, y'all ever heard that furniture companies and clothing and that kind of stuff has a high markup? Y'all ever heard that before? Or comments like that before? That they have a high markup. What that means is, and that is true, clothing has a high markup, and so do furniture stores. Furniture has a high markup, meaning, okay, it may cost them, if they had a 50% markup, if they paid $200 for a chair, then they're going to charge you $300, right? Is that right?
Yeah.
But it's more like 100%, 200%. So if they pay, in reality, if they pay $200 for a chair, they're probably going to charge you at least $400. That's a high markup. They're doubling it. They're doubling their cost to charge you. So anyway, what that does is the gross profit percentage tells you how much they've marked up, or how much the company has marked up their goods to determine sales price. So managers will watch this number, because typically their gross profit number is going to stay within a certain range. So if it starts to deviate, then there could be lots of things causing that. One could be that maybe prices have increased for them and they have not reflected that in their price to the customer. Or maybe somebody has stolen a buttload of their inventory, and so when they counted the inventory, they were short, and had to write off a bunch of it to cost of merchandise sold, so it dropped their gross profit percentage. You know, there's all kinds of things that could be happening. So this is an important number in merchandising in that kind of industry where you're selling stuff, where you're selling goods, because it can tell you a lot about what's happening. All right, y'all do this one real quick. All right, what's your sales going to be? 100%. Okay. I'm trying to like emphasize the things that I've seen via hands in the past. My hope is to, your Chapter 16 quiz/test is available for y'all to take on your own time. We're not going to have a test on 16, a formal test in here. So it's on Cengage. Take it whenever you want to between now and midnight Friday. And then we're going to have a problem from this chapter that encompasses all of the ratios. So my hope is that we get through all of this, and then maybe we have time Thursday, I can print out a paper copy of it and you can work on it in here, or bring your computer and you can work on it where if you get hung up, you can ask questions. Because I mean, it's usually simple stuff that is hanging people up, but if you're not, you know, in front of me, you may not want to message me, or you may not want to wait for an answer, or, you know, so I want you to be able to ask questions if you have them. It's usually, like I said, simple stuff, but it's just a matter of getting an answer quick, and it's a lot of information. Not hard, just plugging a bunch of stuff in, and after a while your eyes start crossing. So, all right, so what y'all get for cost of goods sold?
70%.
Okay, 70%. So what does that leave for your gross profit percentage?
30%.
30. Okay. All right, common size statements. That's another method that's used for analysis. On a common size statement, all of the amounts are listed or expressed as a percentage. So you don't have dollar amounts, you have percentages. And, okay, wrong thing here. So everything's expressed as a percentage. You don't have any dollar amounts. And what's good about those is, okay, so let's say you're opening, I don't know. Let's say you're opening a drive-through chicken restaurant or something that's kind of like Zaxby's or Raising Cane's or something. And I mean, even though you're not a franchise, you kind of want to compare your costs and sales and your operating expenses to what they have going on, just so you can kind of see how you compare. Well, obviously they're huge, and if you're just starting out, your numbers, your dollar amount numbers are going to be vastly different. So one way that you can compare one company to another, and especially if they're different sizes, is using these common size statements, because it puts everything on the same level essentially. So also helps you compare with industry averages, which is a good measure to use if you're trying to see, okay, how am I doing in comparison with the rest of this industry? This is what they look like. So you have two companies, they may be completely different sizes. Like one may have $500,000 a year in sales and the other one may have 50 million. But you can't tell that by looking at this. You can tell what their gross profit percentage is, how much of their selling expenses, what's their percentage of selling expenses in relation to sales. So you can compare the two without having to look at dollar amounts and the differences. Does that make sense? It's easier to compare. All right, liquidity. So liquidity analysis, we've already talked about this a little bit, but it evaluates the ability of a company to convert current assets into cash. So how quickly can they turn those assets into cash? All right, so some liquidity measures. They focus on a company's current position. They look at accounts receivable and inventories. Those are current assets that these measures focus on. All right, and then some of those actual liquidity ratios and measures. You have current position analysis. And so within current position analysis, you have some ratios. I'm gonna show you a chart in a minute. It's a good cheat sheet to go back to when you're taking a quiz. Because you'll have a quiz on this. It's like your current working capital is an example of which blah, 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 blah. And you can look at this thing and go, it's a current position analysis measure. It's a lot of information. All right, so current position analysis is going to tell the company's ability to pay its current liabilities. So what's a current liability? Give me an example.
Accounts payable.
Accounts payable. That's probably the biggest one, you know, or any kind of accrued expenses or anything like that. But accounts payable is, you know, the most prevalent.
Wages payable, stuff like that. I guess,
What'd you say?
I like wages payable.
Yeah, wages payable. All right, so this is going to be something that your short-term creditors, like your vendors, or if you have a short-term loan with the bank, they're going to be interested in this because it tells them how able are they to pay their current liabilities. So these measures of current position analysis are your working capital, your current ratio, your quick ratio. We'll learn to calculate all those. Then we'll look at accounts receivable. And we're looking at these ratios and measures to see how well is this company collecting their receivables. So they leave them sitting out there a long time and let people ride their credit line. Are they collecting the money pretty good? And you want quick collection. All right, so quick collection is going to improve liquidity. It's going to allow the company to expand or improve because they've got cash coming in. And then it reduces the risk of some of these accounts going bad where they can't collect them at all. You can't let them sit too long uncollected without making some kind of attempt. Like, you know, you're going to give everybody their normal time to pay. But if it starts going beyond, you know, I mean, you might have had this happen to you where you get a bill and it says, a friendly reminder that your such and such is past due. You know, you start kind of like that, and then as longer it goes, your account is about to be turned over to collection agency. So, you know, you got to get them collected. All right. So measures that analyze accounts receivable turnover, and number of days sales on receivables. And we'll talk about this more when we get to them. All right, inventory, looking at inventory. What those measures are going to tell you is how well is this company managing their inventory? Are they managing it effectively? Meaning, do they have too much? Do they keep too much on hand where they're tying up their cash by having this inventory that they're not selling fast enough? Are they carrying too little where they're ending up having to do rush orders and maybe pay extra for items because they're not managing it effectively by keeping stuff in stock? Different stuff, you can tell you a lot of different things. You've got inventory turnover and number of days sales and inventory. So here's a recap. These are all liquidity measures. You've got some that measure current position, some that measure or look at accounts receivable and the analysis of that, and then some that do inventory analysis. These are all liquidity, but you know, it kind of, if you're asked a question about where one falls, you can go back and look and say, oh, this is a liquidity ratio that falls under current position analysis. You know, there will not be a test without notes. All right. For any of these, a higher number is better. So the higher the number, the better. A lot of times they'll compare these numbers year over year, and if they're increasing, that's a good sign. That's improvement. All right, so let's first look at the current position analysis measures, which is that column over there. We got working capital, we got current ratio, quick ratio. Working capital, you'll hear that a lot. That's a very common thing that's calculated when, you know, creditors are looking at you to see if they want to loan you money as a business. So that's the formula there. You have current assets minus current liabilities. Pretty easy. The current ratio is current assets divided by current liabilities. And then the quick ratio is going to be the current ratio minus inventory and prepaid assets. You're gonna take those things out of your current assets number, and then you're gonna do the calculation again. So we'll look at it. All right, so current position analysis. We have these numbers on a company's balance sheet, and what I did was I put a bracket over here and said, these are your current assets, and here's your total, just to give you a demo. On this side, I have these top three bracketed. Those are your quick assets. Those are your current assets minus inventory. We don't have any prepaid expenses, so that's not on there. But that's what quick assets are. Your current assets, but we leave a few off. And then accounts payable is the only liability we have on there that's current.
So like, why is inventory not considered a quick asset?
That's a good question. I don't know. Let me see if I can answer that.
It's really hard to sell off inventory.
Yeah, it's probably because you're right. I mean, I think it does have to do with the fact that they're considering quick assets. All right, so it's cash and other current assets that can easily be converted to cash. So yeah, it takes a little longer, like you said, to sell inventory. So they don't consider it to be a quick turnover necessarily, unless you found just the right person to broker it off to or something. All right, so let's do some calculations. All right, so calculate working capital. So working capital is your current assets, and I'm going to abbreviate. If you don't know what my abbreviations are, say something. Current assets minus current liabilities is your working capital. So using our numbers up there, we're going to take 900,000 and we're going to subtract out 350,000. So that's going to give us 550. So our working capital is $550,000. So that tells us of all of our current assets, 350 of it will cover our current liabilities and the difference we have to work with. All right, our current ratio is current assets divided by current liabilities. So we'll take that 900,000, divide it by current liabilities of 350. And that gives us 2.57. Now this is not a percent. Ratios are going to look like that. What I'll kind of give you an idea. If it's a if you've got a measure that says return on investments or return something, then those are going to be percentage answers. But I'm going to tell you when we get to those, so you'll have an idea. You can make a note on your sheet. But these are going to look like that. All right, your quick ratio. So if you wanted to take the 900,000 and subtract out your inventory, you could, or just use your 330 that we had already figured. It's up to you. So we're going to take the quick assets, divide them by your liability, and you get 2.75. So this is quick assets divided by current liabilities. Okay.
Wait, where'd you get 330 from?
Oh, crap. I'm going to have to keep bending this piece of paper because I keep getting the ones below it. Sorry, y'all. Checking you out. Checking you out and see if you're paying attention. All right, so quick assets minus current liabilities. We've got 675. Huh? Divided by, sorry. I'm having to make the little thingy big enough for y'all to see. 675 divided by 350. Sorry about that. And that gives you 1.93 unless y'all tell me I'm wrong.
That's right.
That makes sense? I need a ruler or something that follows my eyes. All right, the next one, y'all work real quick on your own and see how you do on that. Y'all get those? Yeah. Y'all still working on it? You done? You're not waiting if you're not done. You want to check yourself. Those are relatively easy. You just got to remember what each of these means. What's good about this chapter is you're going to have your whole set of worksheets. You're not going to be stuck with just one page of notes, because we're going to do this big problem. You'll have a quiz, but we're not going to take an in-class test on this chapter. So, all right. Let's look at liquidity ratios and measures with relation to accounts receivable analysis. All right, so the first one is accounts receivable turnover. And what that relates to is how quickly accounts receivable are collected. All right, so my lines and stuff got all screwed up. Accounts receivable turnover. The formula is sales divided by average accounts receivable. Okay, how do you get average accounts receivable? Take beginning accounts receivable, add ending accounts receivable, and divide that total by 2. If you're looking at a balance sheet that has 2019 and 2020, or an income statement with 2019 and 2020, let's stick with the balance sheet there because that's where this would come from. So the balance you show on 2019 for accounts receivable, that's your beginning balance. It's your ending balance for 2019, but it's still going to be the same balance on January 1st at 12:01, you know, right after midnight strikes, right? So you're going to use your 2019 AR balance, your 2020 AR balance, add them together, divide them by 2, average. So that's going to give you that number there. All right, so number of days sales and receivables, you'll take this average accounts receivable number you just calculated, divide it by average daily sales. Average daily sales is just your total sales divided by 365 days. To see, you know, just spread it out over every day of the year and see where it comes out. All right, so let's look at this one. We've got sales for 2019, and we've got beginning and ending receivables. God. You know, they give you the numbers here in these examples and stuff, but when you get to the big problem, you're literally going to have comparative financial statements, so you're going to have to figure some of this stuff, but it's not hard. You're taking the 2 numbers that you're given for each year, and those are the ones you're going to add together. So that's our formula. Sales divided by average accounts receivable. We're going to add these 2 and divide them by 2 to get that number. So you're going to take 2,650,000 and you're going to divide that by, yeah, I'm going to show it this way just in case there's confusion. Okay, so that's what we're looking for. You'll take 2,650,000, and the answer to that average is, you said 130.
Yeah.
Yeah, because see, if you add these 2, you got 260. You divide it by 2, you got 130. So we're going to divide our sales for the year by 130,000. So when we do that, my answer. We get 20.38. It looks like a big number, but what that's telling you is how many times in the year did you have accounts receivable go through the whole process of sales. See if I can find their description of it. They're not putting anything in here. It's not helpful. All right, one thing about this little sheet, your colored sheet or your not colored sheet, it does explain better than the general information in the chapter. And this is out of the chapter, but it tells you a little bit more about what's going on. It just says it's measuring the company's efficiency in collecting receivables. So the higher this number is, the better off, you know, the better their collections are. So, you know, if you're comparing year over year and you want to see has that improved, you know, you want a higher number. All right, the next thing is number of days sales and receivables. So you got your average accounts receivable, and you're going to divide that by average daily sales. Well, here's your average accounts receivable that we just calculated. So we'll take that 130,000. We're going to divide that by our sales divided by the number of days in the year. Okay, so what you get when you do that is 130,000 divided by 7620. If y'all want a specific number, 130,000 divided by, I've got my numbers all messed up here, 7260.27. And that's going to tell us that it's 17.91 number of days sales and receivables. Now in this case, a lower number is better because it's telling you, it's kind of like the turnover. It's telling you essentially how long is it taking you to collect these things. So you want a lower number there. Higher number for turnover, lower number for the days in there, okay? So just make sure you take note of which one's better. All right, y'all do the next one. It's got the scratchy pencil. Where's that eraser? Is it? Does that not make your teeth hurt? It's like somebody's scratching their nails on a chalkboard.
I wonder when that happens. Like when you hear like a certain grating noise and makes your teeth hurt.
Mm-hmm.
Like,
I guess it's nerves, like
Yeah.
it bothers your ear nerves, and so
It's like the scientific.
it travels to your teeth.
I hate that.
Mm-hmm.
When like you hear something scraping against your teeth.
Mm-mm. Like a fork on a plate or something. Mm-mm. Look at this. Am I like going too fast? Are you having time to do them?
Yeah, I was doing it like as you were writing it, so I just like looked up as soon as I finished.
I'll get there in a minute, but I'll just write them. I'm gonna start trying to get finished. Did I get it? You're still working? Okay. So let's look at liquidity ratios and measures related to inventory analysis. So we got inventory turnover. So that's going to be kind of similar to the calculation, or the formula is going to be similar in relation to accounts receivable turnover. And then we're going to have number of day sales and inventory. So inventory turnover will take cost of goods sold divided by average inventory. And you calculate average inventory the same way you do average accounts receivable, except with inventory numbers. So number of days sales in there, average inventory divided by the cost of goods sold divided by 365. So same way, just different measures. All right, so we've got cost of goods sold numbers, and we've got beginning and ending inventory numbers. All right, so I've got a note here for you. A higher number here on turnover is better. It means better management of the inventory. And then on the number of days sales, sorry, I keep thinking the number of days sales in the inventory is a rough measure of the length of time it takes to purchase, sell, and replace inventory. So a lower number is better. You don't want that to be too long. All right, so to calculate this one,
Same way.
yep, same way. You're gonna take 700,000 and you're gonna divide it by the average of 55 and 40. So, you know, I could look at that and go, I mean, is that a good number or a bad number? I don't know. What kind of business is it? What's the industry average? I mean, you kind of have to have something to compare it to. You know, obviously the inventory of a jewelry store, the turnover is going to be slower than Walmart's inventory turnover because Walmart's selling stuff like crazy. A jewelry store has high price items, so their turnover is going to be slower. So you've got to be able to compare it to things that are meaningful. All right, so the number of days sales and inventory, you're going to take 47.5 and divide it by your sales number per day. So that equals 47.5 divided by 1,917.81. Leave your decimals alone. It's okay. I wouldn't round anything until you got to your final answer. So just leave it in there because that could mess you up for, you know, you could have one digit wrong. I've seen that happen with my online students. They'll message me because I keep going through this. I keep calculating it and Cengage tells me it's wrong. So I go in there and it might be like they put 7.7 and it should be 7.8. And that's like maddening, you know. Or maybe they put 2 decimal places and it should have been 1 or something. He's just, anyway. All right, y'all do the next one. Just make sure you ought to be fine with it, but just make sure.
Tues April.
Uh-huh.
I think we'll for a second.
Mm-hmm. Here, not too
That's
fast.
a lot to write. That's
I'm
almost like
sorry.
a grad.
I'm sorry.
My hand hurts.
Solid. I need to scan these, I guess, because they got all my notes on them and put them in Canvas. Or I guess I could write the notes out. Probably easier to read. The scanner we have is not too great, so I hate to scan stuff. I'd rather just go in Adobe and write it in, type it in. Y'all ever look at the completed worksheets? You ever go back and check anything or look at them? You do? Okay. Even if it's one person, that makes me feel better. Because it does take some time to do that. So I just, when you're looking at somebody's getting the benefit of it, I'm fine.
Yeah, I do. Like if I run into a problem in my homework, so I'm just gonna go back and look through it.
You good now? You got it? No, you're still right. Well, you know, you will have a video if you need to go back. If you can read, I'm not super crazy about the way that thing looks either. But Zoom times us out after 40 minutes. So it's like, you know, we have to use something that's going to work. choke myself. I break my neck. She had hair down here. Break my neck on that. That's a dangerous thing for me to have. I used to have hair down to about here, and I'd have to like pull it up when I'd go to sleep so I wouldn't roll over on it and pull my head sideways. Many years
So
ago.
I don't have to ever worry about it.
Well, I'll never grow it out like that again. I look like an old hag. I was y'all's age. And I had big bangs and it was permed and super curly. 80s hair. So much hairspray that I was like a walking flammable.
Walking fire hazard.
Yes. Don't like match it. And I smoked too, which was scary. Could have lit myself on fire. We used a lot of hairspray.
Yeah, that's why there's a whole news in there.
Yeah, I mean,
That and all the smoking.
huh?
That and all the smoke.
Yeah, that's it.
Look, we're destroying our planet. I mean, we just need to like go back to nature and eat nuts and seeds and grow our own food. You know, get rid of the cars, ride horses, walk everywhere.
I miss that. Like, I wish I could just write.
Actually, there's a lot of like genetically altered food is actually technically better.
What's better? That's what you said?
Yeah, because it gives like we can make it so that they give off like less waste and stuff like that. Obviously, we don't need to use certain pesticides. But
Yeah. Did y'all get these? So does anybody need to know how we got them, or you all good? All good? Okay.
but
All right.
also like genetically altering food can protect us against like disease, famine. Because like if you have
Disease that we created by like messing with everything.
well, so typically viruses that attack like certain crops
Yeah.
will attack a particular kind of crop. So if you have like varying genetic mutations of crops, it won't attack all.
That's true. All right, so solvency ratios. Let's look at these real quick because we're almost to the stopping point. All right, so solvency is going to show a company's ability to pay long-term debts. We've got a ratio of fixed assets to long-term liabilities. So that measures how much fixed assets. So that sounds so, it came out of the book like that, but it sounds grammatically screwed up. How much fixed assets a company has to support its long-term debt, okay? And it measures a company's ability to repay their debt, their principal amount of their debt at maturity. Ratio of liabilities to equity, stockholders' equity shows how much of the company is financed by debt and how much by equity. So remember, debt's going to be like bonds, loans, things like that. Equity is going to be stock. And then it indicates a margin of safety for creditors. Times interest earned is called the coverage ratio sometimes. Measures the risk that interest payments, okay, so if their earnings decrease, the risk of, will they be able to, the company still be able to make their interest payments if earnings decrease? So that's what that measures. And the higher the ratio here, the more likely they'll be able to keep paying their interest payments if earnings decrease. All right, so ratio of fixed assets to long-term liabilities. You're dividing your net fixed assets by your long-term liabilities total. And I mean, it's kind of self-explanatory. Liabilities to stockholders' equity, and we've got totals to work with that go over onto 2 pages. Okay, so let's look at Stanley Corp's information. We've got the ratio of fixed assets to long-term liabilities. So we're going to take our $1,250,000 of net fixed assets and divide it by our total long-term liabilities, which is $380,000. And you get 1.92. Okay, then this next one, you are taking your liabilities and you're dividing by stockholders' equity. But notice, okay, never mind. I mean, it's just, they've made it really easy. I mean, because when you get that big problem, it's like, you gotta be able to come up with some of these numbers. So I kind of want to do it twice. Okay, times interest earned. Oh, wait a minute. Did I give y'all the wrong answers again? No, this is supposed to be 20. Dadgummit. I did it again. I'm moving. I'm looking down the page instead of using. Okay, sorry. Let's try this again.
I wrote that in pink pen.
I'm sorry. You want me to give you my whiteout?
Sadness.
I'll give you my whiteout. You can fix it. Okay, sorry about that. All right, use your, y'all do the next one. Here, you can use my whiteout. Look, I hate scratching through stuff in pen on my notes. It's like it's a visual distraction for me. I can't stand it. So I get it. I'll make fun of you, but I get it because I do the same thing.
I hate it because when I go to study, I'm looking at this.
It distracts me really bad. All right, notice that I wrote on the first calculation, a higher number is better. On the, because what it's telling them is they're using their fixed assets efficiently or well. And then on the bottom one, a lower number is better because you've got how much do you have in liabilities as compared to your equity. So you want that to be low. It's Stanley again. I copied and pasted a lot of this stuff and just changed the numbers. That's why I have got to go back and revamp this thing. I've got too many mistakes in here.
On the first one?
Yeah.
You said we divide our long-term liabilities, right?
Yeah, what'd I do? Oh, it's supposed to be 650. I got the right answer. What do you want from me? I'm kidding. Sorry. Of course it is. Sorry. All right, if it makes you feel any better, I'm getting migraines. That's not helping my cause. It's making me stupid. Sorry. And the fact that these numbers are hanging over 2 different pages. Y'all know usually I do better than this. So I'm in a hurry. I've gotten behind. All right, y'all got y'all had a chance to get your numbers yet? Did I move up too fast? What you need? Huh? Yeah, just set that paper on fire with a pen. I guess I've just gotten used to I can write furiously fast. I've had people look at me and go, oh gosh. Because anytime I go to any kind of, if it's church or if it's some kind of continuing ed, I mean, I'll write a lot of notes because it keeps me focused. And then that way I can remember what I don't have to, what was that they said about so-and-so? What my notes. I literally almost write everything they say. So I can write super fast. It's just it's my way I focus. So did y'all get these numbers? Yeah, everybody good? Okay. Times interest earned. The formula is income before income tax plus interest expense divided by interest expense. So on this first one, and note the instructions say rounded to 1 decimal point. So we're going to take our $3,500,000 income before income tax, subtract out the interest, and divide by the interest, which is weird, but that's the way it works. And we get 18.5. Okay, so you have the, you work this one. I'm going to give you the answer. So you're not, you can go ahead and work it if you want, or you can do it, because that's all we're gonna do for today. Is thumbs up. All right, this is the deal. We've got a few more to go over, but it's really probably not gonna take very long. So my plan is to bring, y'all all right? A paper copy of the problem to class Thursday. I mean, you may or may not be here, but what I can do is I'll get the video going and kind of point out some things that might be confusing so that when you encounter those, you'll know which direction to go. Because like I said, you're not gonna have it this nice, neat, and clean. You're gonna have financial statements to deal with. So I just kind of want to point out the things that might be pitfalls and kind of give you some direction where you're not spending so much time on it. So anyway, if you're not going to come to class, I'll put it where you can print it or you can pick up a copy. But if you are coming to class, might not be a bad idea to bring your laptop if you want to. So when you're working on the problem, you can go ahead and put the answers in if you want to. And make sure that you're formatting it the way that Cengage wants you to, so that if you have an issue, we can work through it. Or just do it on paper, put your answers in later. It's up to you. If you have a trouble with it when you're putting the answers in Cengage, you can always message me. Because like I said, often it's like you have 13.77 and it wants 13.78. You know, it's something simple, and I don't want y'all wasting too much time spinning your wheels. So, all right, y'all have a good one. And I'll try to get this completed worksheets out in the modules.